Okay, all right. William, hi, good morning. Good to see you, Ben. A quick word on the earnings season in the United States. Some of those banking names, numbers didn't look too bad, but some of those stocks are selling off post numbers. However, we had a couple of positive numbers. PepsiCo, case in point, the numbers were, welcomed very, very well. What are you making of that? Because most of the growth in earnings in the United States will be because of the Magnificent Seven. X of that will be, around 3% or thereabouts. So your expectations with regard to earnings season, and just comment on that factor that you're talking about. Tariff, the fear is inflation moves up. But you're saying gasoline prices as well have come down, which actually won't move the needle too much. Quick comment on earnings as well as inflation. Go ahead.
Nigel, as far as the earnings front is concerned, I think your President's opening remarks are absolutely spot on. There are a lot of policy interactions that are not being talked about and that are being ignored. The interaction of the investment incentives in the tax bill and the tariffs, I think, are now coming home to roost and showing that the big tech companies are benefiting from that. Jensen Huang is going around the world saying, hey, I've got chips to sell, and he's doing a phenomenal job selling to sovereigns, and the sovereign AI market has now become a very, very real phenomenon. The tech industry is doing very, very well, but as you say, other parts of the U.S. economy are also starting to catch fire. If you look at the latest GDP numbers, very few people have reported that actual fixed investment, business fixed investment, especially on the research side, has been growing double digits. And as consumers are slowing down, business investment is really on fire. And I expect that to show up in future profits and better performance on the stock market. As far as the inflation front is concerned, again, I've said so many times on this show, and I hate to repeat myself over and over again, but the U.S. is a relatively closed economy. The consumer basket for U.S. People is about 70% domestic services, 30% goods. Of the goods, about 25-30% come from imports. So if you knock that stuff together and talk about, say, a 25% tariff or 20% percentage point jump in tariff rates, that will raise consumer prices by under a percentage point, especially if you consider the drop in energy prices. You mentioned gasoline prices have dropped by 10% over the last year. And if President Trump's policies continue, they will likely be either stable or continue to decline. So the inflation front looks very good, and the excuse that the Fed has been using for not raising rates, as Governor Waller has been telling you, that excuse is starting to fade very, very quickly. And as soon as we hit, say, autumn and September, when we get one or two more price readings on CPI and other inflation measures, we're going to see that the tariff increase may be much, much less than the fearmongers have been saying.
William, thank you very much. Good speaking with you. Appreciate you joining us here on the program. It's always a pleasure. We'll take